Hi everyone! Last week was rather eventful on Wall Street. There were plenty of events and reports that affected market sentiment. Stocks resumed growth. The key event was the Fed meeting. Apart from that, investors anticipated US GDP data. This indicator is an accurate gauge of how the economy is performing. Traders thoroughly studied this report to understand how resilient the economy is. It could also help them pick a better trading strategy and profitable assets. The new week is going to be rich in events as well. The NonFarm Payrolls report is on top. It will provide an insight into the labor market conditions and economic prospects. Speculators will also monitor other economic indicators such as factory orders, job opening, as well as the ISM manufacturing and services indices. As seen, there will be lots of crucial events for stock markets. Traders are going to carefully analyze all available information in order to make correct decisions and adapt their strategies to new conditions. Markets are full of surprises and interesting events. This is why it is important that you always have the latest market news at your fingertips. Watch our video review and find out what events you should pay attention to. Let's start. According to the consensus forecast, the economy is likely to add 184,000 new jobs in July versus 209,000 jobs in June. The unemployment rate is expected to remain at 3.6%. Annual wage growth may exceed 4%. New figures are extremely important as the Fed will take them into account when making monetary policy decisions before the September meeting. In August, the Fed's Jackson Hole Economic Symposium will be in the spotlight. Policymakers might give more hints at future plans for key rates. The majority of analysts believe that the interest rate has already peaked. Some assume that the tightening cycle is already over. Although there are those who expect a rate increase at the September meeting, their ranks are getting thinner. There is a 77.2% probability that the regulator will keep the key rate unchanged at 5.5%. As for monetary policy easing, Jerome Powell has mentioned once again that the Fed has not considered a policy reversal this year. Perhaps this is a clear signal that the regulator is not going to cut rates. However, the Fed also assured that it would not raise rates to tame galloping inflation, yet it did the opposite. This is why one should take policymakers' comments with a pinch of salt. If the time is ripe, the central bank is likely to start easing policy despite the signals. Fresh figures revealed that inflation was easing steadily. The economy remains resilient despite aggressive tightening. Perhaps Powell is right and the US will avoid a recession. However, a slowdown in economic indicators is already taking place. This is quite predictable. GDP exceeded expectations and expanded in the second quarter. A tight labor market boosted consumer spending. Businesses invested in equipment and construction, which mitigated recession risks. Economists who previously predicted a recession in 2022 now believe that the tightening cycle is coming to an end. Investors were optimistic at the end of the week after the PCE price index declined further in June. The latest GDP data demonstrates the resilience of the economy, fueling hopes that the Fed will soon move to a softer stance. The improving inflation environment was reinforced by other data showing labor costs posted their smallest increase in 2 years as wage growth slowed. It indicates that the economy is moving into disinflation mode, with consumer prices moderating sharply in June and producer inflation muted. Together with a strong market, which is underpinning consumer spending, led to cautious optimism of a soft landing for the economy. As a result, stock indices climbed higher. Last week, the Dow Jones was again in the limelight, extending its rally for 13 consecutive sessions. However, there was a pause in its upward movement on Thursday, as GDP figures above the forecast somewhat confused investors. Strong economic data confirmed the resilience of the economy to aggressive tightening and fueled hopes that the US may continue the tightening cycle in September. It caused a sharp rise in Treasury bond yields, forcing the Dow to drop by 100 points and stop the rally. At the end of the week, it added 0.4%. The hype over the Dow Jones overshadowed the other important events last week, including the Fed meeting and Powell's speech at a press conference. Market reaction to the Fed meeting was the most muted in the last 9 years. Even after Powell's press conference, there was no surge in volatility. Investors were more concerned about whether the Dow would close in the black and show the longest rally since 1987. If the Dow had closed on Thursday at least with small gains, it would have logged the best dynamics since 1987. Back then, the index had been growing for 14 days in a row. On Wednesday, the Dow advanced mostly because of an 8.72% increase in Boeing shares. Demand for them rose markedly after the publication of a strong earnings report. It showed a significantly higher adjusted operating cash flow for the second quarter. The indicators surpassed the forecast reading markedly. At the same time, speculators seem to forget that Boeing flipped to a $149 million loss in the second quarter despite higher revenue. They are more focused on positive indicators but not on the company's profits. As for other earnings reports, Intel stock appreciated by 6.6% on the back of strong quarterly results and an optimistic outlook. Nokia shares jumped by 31.3% after the company reported a smaller than expected loss for the last quarter, while its earnings were above forecasts. Procter & Gamble shares stock rose by 3% as the company revealed upbeat results and forecasts. Conversely, ExxonMobil shares fell by 1.2% amid mixed second quarter results. Ford shares declined by 3.4% after the company postponed production of electric vehicles to next year despite strong quarterly earnings. Last week, the S&P added 0.8%. The stock market is sensitive to economic indicators. The S&P index is hovering near its historical highs, but its upward movement is unstable. The index is growing thanks to a rally of shares of several high-tech companies. Without them, the dynamic of the index would have been different. Aggressive tightening does not affect tech shares as investors are still optimistic about the tech sector prospects. Other sectors could stagnate, having a negative impact on the S&P index. It may continue to rise, but it will hardly reflect the real state of the economy. Besides, the consequences of monetary tightening on the economy and profits of companies usually appear later. If the dynamics of leading economic indicators and corporate profits are weak, the stock market may resume a downtrend. This should be taken into account when making predictions. The uptrend of the S&P is weakening. If the index climbs above 4,630, it may test a high of 4,820. The NASDAQ gained 2.1%, showing the best weekly results. Overall, the movements on Wall Street were quite lackadaisical last week. This week, earnings reports will shape market sentiment, so speculators should pay great attention to them, especially to Pfizer, AMD, Caterpillar, Starbucks, Qualcomm, Apple, and Amazon. The quarterly results of the first three companies may trigger volatility. They will be released on Tuesday. That is all for now. Please leave your comments down below. See you.